You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm Andy Tanner, your host. This is where we do our very best to keep investing simple. I am over the moon excited for this particular episode. It's really the perfect episode, I think, for what's happening in crypto right now. We're seeing a surge in Bitcoin, and I've always been very, very interested in the story of Tether, which is a story I think that remains to be told. It's still unfolding, and today I have a marvelous guest who's blogged on this. She is one of the most knowledgeable people I've ever found. I came across her blog, and as I read it, I just hoped that she would be willing to do a podcast with us. So with that, I'm just grateful to have Carol Alexander, and you can get her information at coalexander.com. Carol, thanks for being with us today.
Hi, Andy. Great pleasure to speak to you.
And we appreciate you from the UK, no less. Amazing technology. It sounds like you're right next door. So fantastic stuff. Carol, tell us a little bit about your background, and so people know a little bit about you and some of the things you've done. It's quite a resume. But tell us what brought you to the point where you became interested in cryptocurrencies in the first place.
So that would have been around 2014. And it just coincided with me looking for a new area for my research. I tend to change areas. I've started, my original research area was actually algebraic number theory way back in the 1980s, and game theory, sort of algebra things. And then I moved more to data analysis, statistics, econometrics. And then I got more into risk management, financial market risk management. And then I got into sort of highly complex mathematical finance for exotic products and volatility analysis and things like that. So I was just ready for a new subject, really. And I was, the more I looked at crypto, the more it appealed. First of all, the anti-establishment side of it.
Yes.
Appeals to my nature.
Well,
and secondly, it's the research challenge, because the market microstructure is so interesting and fragmented and new, and all the products, you don't see quite a few of these products in, so it's a challenge as well academically.
And people should know that in addition to, massive algebraic number theory, risk analysis, you've worked on modeling for many different places, risk modeling. And so that's your background, is to look at something and say, okay, what are the risks that we have here? So it's quite a background. I can see why you might have been where the appeal comes from with your background, saying, well, here's a new challenge, because crypto is quite a new idea and a new frontier. So let's talk about this. I try not to be dogmatic. Many people who have become enamored with crypto have done so in a way that it's almost political, or almost like a religious fervor, to where it's not an asset, it's a movement for many people. It's I don't know if I'm articulating it well, but when I think of a bar of gold, I think gold. When I think of, I'm going to go buy a stock, I'm going to run a fundamental analysis on the company, and I'm going to, see what their balance sheet looks like. I'm going to see what their earnings. I'm going to look at some valuation numbers and say, is this a company I'd like to own? But I'm not part of a movement to buy a certain, stock or a company. And so I try not to be dogmatic for or against. I've enjoyed watching the options market associated with crypto, and I enjoy covered call writing in the stock market. Very difficult to do in the crypto markets, because the spreads are wide, the strikes are wide, the liquidity is still in its infancy. It's very low. I'd imagine that would increase more, but it hasn't as I've traded it. But here's the thing I think is interesting. When we look at the folks who really love crypto, they say, well, we love it because it's a non-centralized product. We don't have a central bank controlling it. We have this open ledger. The other thing about being non-centralized is we have the ability to check this ledger while at quite a cost of electricity, quite an energy cost. It's double checked to the nth power, all types of nodes all over the world, recording this ledger. So it's an audited ledger, and people like it for those reasons. So then we have Tether, and to my understanding, it's easier to go from a stable coin Tether to a cryptocurrency and back than it is to perhaps a US dollar or British pound. But Tether's non-centralized. Tether isn't audited. They keep promising one. Tether is almost the antithesis of everything they got into crypto to be, and half the crypto transactions, I'd imagine, going through Tether. So would you comment on that? Does that strike you as quite an irony? We want to get away from the US dollar because it's too volatile. They're printing too much. And yet we want to be tethered to the US dollar because crypto's been too volatile. So could you give just an overall opinion on those ideas with Tether, the fact that it's almost the opposite in terms of its appeal to where something like Bitcoin would be? A long question, so I'll wait for a nice answer.
Okay, well, I think I'll need to just go through a few things that you said there. I mean, Tether Phase 2 is very different to Tether Phase 1. It is audited, and before we start talking about Tether Phase 2, I think what you said about decentralization, about blockchains, and you said Bitcoin. So Bitcoin is very confusing because it's the name of the native token of the blockchain, and it's the name of the blockchain itself.
Right.
So most of the ecosystem is on a blockchain called Ethereum, where the native token is Ether. And what we mean by the native token is the token is integral to the building of the blockchain because you earn it when you add blocks and you spend it when you send like cars along this motorway, the smart contracts.
Right.
They take something called gas, which is paid for in Ether. So the native token is really very much a commodity within the ecosystem supported by the blockchain. And the blockchain is run in a very decentralized way by a massive peer-to-peer network that checks the validation through something called consensus.
Yeah.
So that, on the one hand, is highly decentralized. But then the native tokens like Bitcoin, Ether, and about 20,000, maybe not 20,000 native tokens, but there are tokens of all sorts.
No shortage, yeah.
So there are about 20,000 of these. And so all these trading pairs are traded in two types of markets. One of them is very centralized. The centralized exchanges is highly centralized market. Binance, for example, FTX, very centralized, run by individuals, big contagion effects to the rest of the crypto industry and to even traditional banks now today. Well, small traditional banks like Silicon Valley Bank. And
Yes.
Anyway, so, you've got the dichotomy already between an asset or a commodity. It's difficult to know what you would call Bitcoin, but Ether I definitely classify as a commodity.
Sure.
So, that is by and large, the options markets you referred to, the spot trading on Coinbase or whatever, this is run in a highly centralized way. It's not decentralized at all. It's only the blockchain that is. And Tether is different. It started, actually there is a smart contract carrier for Bitcoin, even though it's a clunky blockchain, just a joke to begin with, proof of work. There is something called the Omni layer, which will carry smart contracts. A smart contract, most tokens, like non-fungible tokens and that, they reside as certificates of ownership in this blockchain. And so Tether is minted by the Tether Corporation. And then it's sent originally by the Omni layer, which is the Bitcoin. But then now through about 20 different, it's everywhere on every single blockchain. They can mint and send. They used to send it originally to Bitfinex hot wallet. That's you see, these centralized exchanges are not on the blockchain. The hot wallet is connected to the blockchain, but if you upload US dollar to Binance, nobody can trace it or any other exchange. If you are lucky enough to be able to offload fiat from Binance, which is much more difficult than you might think, it's a sort of black hole for fiat, to be honest. But if you offload fiat from Binance, that's not recorded on the blockchain. So, it's just up to you and your tax return. Whereas if you upload crypto to these exchanges, that's recorded in the exchange hot wallet, which then goes into the cold wallet off cold storage, so it's safe from hacking and so forth, right? Anyway, so the Tether was originally sent to Bitfinex and then distributed to other exchanges as a sort of blood for trading crypto, because most of those exchanges were not fiat exchanges. It's only more recently, led by Binance, that you can onboard fiat using your credit card. But local regulators have been trying to stop that. Nevertheless, they haven't succeeded. And, we know about the CFTC case against Binance now. And so, Binance is a different issue to Tether. The question is Tether, even though the two were inextricably linked way back when Tether had no proof of reserves. Now it has. Now they're audited. You go onto the Tether website and you go to the transparency section and you'll see real-time audited holdings of their reserves. Now, what they are is still a problem, but at least we know what they are. There could be government securities. A lot of them are US Treasury bills. Most of them are in non-crypto assets, okay? So it's not a sort of vicious spiral where, you finance yourself with crypto that, it's all just an edifice of candy floss. No, they've got some real reserves in there. It's still a problem. The holdings of US Treasury bills are actually a bit of an issue.
Yes, they are.
Tether itself is still very much a problem, but a different sort of problem to way back when Binance and Tether were using this Deltec bank in the Bahamas.
Yeah.
And, there were these signatures like, who on earth's that supposed to be? And it was quite clear that they had a lot of what they called commercial paper, which is basically an IOU, maybe from Binance, saying, okay, Binance takes all the Tether to do the trading, takes the fiat from the ordinary investors that on-ramp to Binance, pays its staff in the local currency, but uses Tether in lieu of that. So instead of being the proper broker for Tether, I upload dollars, I'm going to trade it across Tether. So for every dollar I upload, they should send that dollar to the Tether company in order to get my Tether.
Yeah.
But they weren't. They clearly weren't. That's why Tether couldn't attest to its reserves, because exchanges like Binance were not passing on the fiat, I'm sure. I mean, I haven't got proof, but that's the only story that fits all the facts.
I think the fine point you did hit is, there's an audit that says, well, here's the reserves we have, but the exact type and amount and distribution of those assets, I think is an important thing. And for folks that aren't familiar, and you tell me, because this is the analogy I draw, and it might not even be correct, but in the stock market, you don't really move cash from like you would a savings account to buy something. It's generally done in a money market. When people put money in savings, a bank discourages lots of interaction. That's why we have checking accounts. Because savings is supposed to be a long-term type of idea where they can lend that money out to housing generally, something like that, and they can make a spread between what they pay on the savings and what they get on the mortgages. I think Tether.
That's what banks are supposed to be doing. That's
in theory.
Got some interest rates to work with.
with Tether, I feel like it acts much like a money market for the crypto markets. Just as a money market fund allows me to exchange back and forth from a cash equivalent, like a money market, to a stock and back and forth. The challenge money markets have is, what for new listeners is something called breaking the buck. If I put $1 in a money market, I really expect it to be $1 tomorrow. I don't expect it to be like a gold or a stock that might go up and down, or even a crypto. I expect $1 today to be $1 tomorrow. So in order to pay their employees and run their operations, these people, they have to invest that. And generally, there's 2 or 3 places they're limited to. They have to be very conservative investments. First, you mentioned government securities. In the United States, we might look at a treasury bond or a T-bill. Commercial paper you brought up, which is short-term loans to corporations. Traditionally, we would hope to have healthy balance sheets and ability to repay. You loan money to Apple, they probably have a better balance sheet than most countries right now. And then we have a reverse repo market run by the Federal Reserve. Could be a place where you could invest. So the returns are very small. So we have 2 problems with this. First of all, you mentioned that as the rates have risen, the previous bonds have fallen in value. And so that's the problem with treating a bond or a treasury as a cash equivalent, because if we get an environment where we raise rates, that's what Silicon Valley Bank started having problems with. People wanted to draw.
But Tether's got 48 billion around that in US treasuries of average maturity. They're just bills. They're very short, around 1 month.
Yeah, and they have to
doesn't have that long-term interest rate
because problem. they have to be able to liquidate, right? But you mentioned commercial paper, and I read an article a long time ago with. I think it was a Bloomberg article that they said they have a lot of commercial paper, but they can't find a lot of the commercial paper, people doing business with them.
That was a long time ago. Not now. If you look at the transparency section, very little commercial paper is left. I think Binance have paid them back.
So I get it that you feel pretty confident in Tether.
I'm frightened of Tether, more so than even Circle. I mean, with Circle, obviously, it got hit by having a small exposure. I think they were saving 3.3 billion with Silicon Valley Bank. But Silicon Valley Bank had a lot on both sides of the balance sheet with the savings and the loans. They'd given loans to tech startup companies very involved in crypto. So they had a big concentration risk. At the same time, that Jerome Powell, back in 2018, really, really, really lightened the regulatory load for banks like SVP. Very few stress testing, the transparency of positions, and what this has shown is that, in fact, that it was done during Trump regime, but it needs to be revisited. I think that banks like these 3 S's, they all, Silvergate and Signature and Silicon Valley Bank, they need specialized stress tests, crypto-based stress tests, because contagion can come over from the crypto market very, very easily. It's happening all the time. Anyway, so that's another topic.
So
going back to the Tether.
Yeah, tell me why you said that there's some fear, that you have a little bit of fear with Tether. Where does that come from?
Well, it's to do with the ownership. Well, for the USDC, it's the ownership of these treasury bills. It's only 26 billion for USDC, 48 billion for Tether. So, it's not a huge size of that market. It's a massive market. But nevertheless, anybody can basically own US government debt. Normally, foreigners can do it, but there's know your customer. They have to show their tax ID and all sorts of things in order to hold US Treasury bills. But not now. Anybody can de facto hold them anywhere in the world. No KYC whatsoever with Tether. And that's worrying. We don't know, as these things get larger, we don't know who's going to be owning those bills through. And there are links to all sorts of large foreign powers in Binance, possibly also Tether. So that's concerning, particularly when, this BlackRock Circle Reserve Fund that they've set up. So BlackRock have taken over managing USDC, and they've got this fund which they want to give access to the repo facility, the overnight repo, reverse repo, which, is getting more and more into bed with the Federal Reserve policy, or the Treasury. They can't get enough cash to finance the huge spending just soared at the beginning of the pandemic. The money supply went from 4 trillion to 20 trillion just overnight, more or less then. And so how are they getting all that money from? And they've run out of cash, or what banks have in their liquid deposit. So now they're going to the crypto market to fund the US debt. It's quite frightening, I think that is.
Yeah.
And then Tether is getting into bed with them even more by, if you look at that transparency page, it says, Tether keeps the US dollar strong.
Yeah, the US dollar is, being tethered, to me, it's strange because we don't want to be tethered to the US dollar. So people go and, whether it's Ether on the Ethereum blockchain or Bitcoin or any of the other cryptos. So we say, well, why are we buying crypto? Well, it's better than a dollar. It's non-centralized, all the things we spoke of before. And yet Tether is tethered to the dollar. And I wonder about the United States' position as the world reserve currency. I wonder, I don't think it ends overnight, but I certainly think the way China is buying oil, the relationships people are having with other currencies, I think the dollar is very much troubled. So is that where the fear comes from? Is the more Tether's tethered to the dollar and the weaker the dollar is, the more precarious Tether is, or?
No, actually the reverse. I get concerned about dollarization of the world. Maybe not Brazil, but many countries in Latin America are now tether economies.
Yeah.
It's legal tender wherever you go. You can get tether out of ATM. Well, you can't actually get tether out of ATMs, but you can your balance and you can pay for everything electronically in coffee shops. You get your salary in tether. So a lot of the South American countries, are like that. And the Europe, I think there's some regulation that's been passed into law already in Europe called the Markets in Crypto Assets last year. And one of the big issues they debated for some time was stablecoin use. And this law now in Europe restricts the trading volume of US stablecoins. So the Circle US coin and the Tether US coin. I mean, Tether now has a euro tether. That's a huge amount. I mean, the market cap's going up all the time. They have a Mexican peso tether. They have tether in, 101 different varieties.
Right.
But anyway, the trading volume is highly restricted to something tiny in total, something like $200 million dollars a day, something really tiny. On any European platform, but euro stablecoins are not limited.
Tell me a little bit about the future. The comparison I often make is, I remember the first time I went online. The first time I ever got online and looked at a website was through a browser called Netscape. And my sons wouldn't know what that is. My sons are 15 and 17. And they would have no idea what a Netscape is, or what a Napster is, or even what a BBS is, or any of those types of things. Now, the protocol, Hypertext Transfer Protocol for the web, and SMTP protocol for email is still existent. And I always feel like innovation is like that. You have a word perfect processor that's swallowed up by Microsoft Word. You have a Quattro Pro spreadsheet that is swallowed up by Excel. You have Netscape that's swallowed up by Firefox and Chrome. Where does Bitcoin stand? Are my kids going to talk to their kids and say, yeah, remember Bitcoin, in the same way you and I you kind of lit up and smiled when I said Netscape. You guys said, oh yeah, I remember that. Are we going to think about Bitcoin that way? Is blockchain technology the best of the best? Or are they going to invent something better that's even more secure, has less carbon footprint? Is this technology changing that fast? Or do you feel like, yep, it's going to be, like you meant, I understand the problem with calling them Bitcoins because, it's not a physical commodity. It's just all these things reside on this ledger. What's the future? Have we hit what we're going to be established? Or are we still in flux and still in the wild, wild west, so to speak?
So let's talk about the blockchains first, and then we can talk about the crypto, because they're quite different, really. And blockchains come in all sorts of shapes and sizes: layer 1, layer 2, layer 3, layer 0, which is a sort of interoperable layer. And these are cash-rich in general, and very innovative. Obviously, Ethereum's the main one because the roadmap for that was set way back in 2017. Vitalik Buterin had his vision for all the different upgrades and so forth. And the original proof of work at the electricity consumption, silly sort of jokey thing, was discarded a year ago. And so they use something called proof of stake, which, as long as you're rich, you can earn money. It's not very egalitarian. The more money you stake, the more money you can get. Yeah, but it doesn't use a lot of electricity, so it's not. It's a green type of blockchain, and there are about a dozen fairly popular different types of consensus mechanisms: proof of history, proof of authority, proof of space, all sorts of stuff. And so these are evolving all the time. The majority use some form of this proof of stake, the one where you need to be rich to do it, and Bitcoin is unlikely to go that way because, you see, it's a peer-to-peer network. Everybody would have to vote on changing the software. And it's different to having this visionary leader, Vitalik, who has been explaining to the whole community that this is going to happen in a year from now. It's countdown. Everybody knows what to expect there. But if suddenly somebody came to the Bitcoin network and say, hey, let's move to proof of stake, the miners would go bananas. I mean, there's obviously multi-million-dollar businesses now shipped from China when they banned mining to the US. But it's not environmentally friendly at all. Not only that, as a blockchain, you've got this omni layer, but it's a clunky one. It's very slow, great big blocks, 10 minutes a block. The speed will never rival anything that we can do nowadays with some of these new blockchains. So it's a dinosaur, and I think it's on its way out. But it's like Tether. It is intrinsically bound up with Binance again. Binance, to me, is the core thing to attack, to make sure that this space is back into its origins of decentralization, power to the people, peer-to-peer, etc., etc. But Binance has corrupted all of that, and it's got its own blockchain and everything, but there's no regulation, which means that anybody can perform any number of manipulative spoofing trades they like all the time, and they're free. They can, the professional traders on Binance, they don't pay fees. Binance brings them the retail investors that pay fees, and then they get automatically liquidated. Binance doesn't even report liquidations properly. Only one per second at most. There can be thousands of liquidations in a second. And we don't know. One of the things I want to work on is actually finding out exactly how much is liquidated. How many. It's usually the retail traders, not the professional ones, who are having not only that particular position just wiped out, but they could have the entire account with all the positions on Binance could just go like that, and they'd be made bankrupt. in the middle of the night without warning if they're not running software to monitor what they call the liquidation prices of all their positions. So this is a horrible position for retail traders to be in. I'm trying to warn them not to trade in these leveraged derivatives markets. Go to Coinbase, take some spot, you're safe there. But don't try all these derivatives or these variable leverage tokens. These are really toxic products. So just to close the loop, Bitcoin, Binance, and Tether, the three of them together need to be addressed. And I think Bitcoin will bite the dust. I predicted this year, on the 2nd of January, that there would be a managed rise up to 30 by Easter. And that was when it was around 15.
Yeah.
So I've been right so far. I said it would then plateau. I chose 30 because it's a resistance level. It's been at for ages, years and years.
It's back in June was the resistance level of around 30, and we're bumping it. In fact, I'm looking at the chart right now at your 15 and your 30 is your resistance level.
Yeah. And then depending on what happens by September, if Binance is still doing what they're doing, playing football with their clients' money, and the professional traders are joining in as well from, a lot of them from the US, it's clear. Because when you look at some of the work I've done, you'll see the time spikes, the volume spikes go up when the US wakes up. It's clear. It's like FX markets.
For sure.
So you see, you're right. They are using VPNs to trade. Anyway, so those three, I think Bitcoin will bite the dust in the end. It's just a toy. It was never meant to be, really. It's become a sort of Frankenstein now. It
is kind of interesting that you could use the phrase. I kind of smiled when you said, well, it's a dinosaur. And I thought, there's very few crypto experts, who comes in and says, yes, I've been trading crypto for 50 years. There's no Warren Buffett type of experience with crypto. Talk to me, you mentioned regulation. To me, I think it's a fascinating dynamic. Bitcoin is, some people say the dollar is the government's money, gold is God's money, and Bitcoin is the people's money. I've heard it said that way. And the idea of a central authority, they can't, if you're the Federal Reserve, you can't enjoy the idea of a non-centralized currency that basically bypasses and potentially replaces your dollar. They want to print, they want to control interest rates. If there's a war or a pandemic, they want to print. They have I think Jerome Powell and even central banks in Europe and central banks in Asia, they're in a rock and a hard place. They're trying to control inflation from this. You mentioned this, it really takes your breath away, the amount of money they printed and overprinted, in my opinion, during the pandemic. And to try to tackle that, it's rough. So how does a government deal with cryptocurrencies, because they want to retain some control and some power? China says, oh, it's going to be illegal now. We can't mine this here. What's your opinion on the future there? Is this something central banks embrace, or is it something that they fight, and who wins?
Well, central banks have been focused mostly on CBDCs, central bank digital currencies.
Yeah.
And a few years ago, there was mild interest, and now there's major interest. It's still very much at the consultative stage, but to be clear, what we mean by a CBDC would be different to the sort of cryptocurrencies that we have at the moment. First of all, it would have to be on what we call a private blockchain, not a peer-to-peer blockchain. This still operates in a similar way with a consensus that makes sure that things are all valid, but the type of consensus would more likely be done by figures of authority. And nevertheless, there need to be, there are these consortium blockchains already. For example, R3 Corda, many banks have a consortium using that. where they do their interest rate swaps and interbank transfers and so forth. So, they can do this on a blockchain, but of course, when they do it on the blockchain, they need some sort of currency to do the transactions in. And that's where the CBDC would be useful. Plus, as more and more people move to a cashless economy, linking retail banks into the same type of CBDC network would allow them much closer scrutiny of money supply and so forth. But, when it comes to tying everything up with their monetary policy, are they going to issue a 100-year bond, which is what the US do, to just pass on this debt to your grandchildren?
Yeah.
But if they're going to do that, then they need to do it in the blockchain. And the banks that offer brokerage services and so forth will need to be in this private blockchain network. So there's a huge amount of work, much more than I think some central banks realize, and it will probably be years. Meanwhile, stable coins serve that role.
Well, it's a fascinating world. It's going to be interesting to watch Bitcoin. I've watched it surge with the Silicon Valley Bank failure, and there's been a little bit of contagion. I really think the Fed, if they'd have come out with their backstop, they could have saved Silicon Valley Bank if they'd have wanted to. I mean, the policies they put in over the weekend would have saved that bank. So I don't know why they didn't do that retroactively, but they make their decisions on how they make their decisions. But I would say that, one of the reasons I'm so grateful to have you on this podcast is this is such a learning curve for the average person. The nomenclature, see all the different acronyms, and what is a blockchain, and what is a node, and what is a peer-to-peer, and what is proof of work or proof of stake or proof of whatever. And people, I think globally, most people aren't educated. So your work is vital to the world right now. It is one of the reasons I wanted to have you on. Even if people didn't understand everything you said, at least they have a website now they can go to and someone they can follow that has studied this more intensely. I've had many quote unquote crypto experts on the podcast, but I've never seen anyone with the grasp and the study that you have. So we're just so grateful. Could you give some counsel to the listeners from an education standpoint? How important is it for them to understand this new world of crypto? And how deep does a person need to go? I mean, a lot of people survive with the US dollar without understanding monetary policy very well. They probably don't understand what quantitative easing is, or what a mortgage-backed security is, or what a reverse repo market is, and they make their money and go about their life just fine. Could you talk about the depth and breadth of a person's knowledge of crypto that would be advantageous to them even in the coming months?
Gosh. Well, first of all, thank you very much for such kind comments. I'd better start blogging again.
They're heartfelt.
Carve out time most weekends.
I guess I'm saying you are needed because everything you've read, you don't blog every day. I've noticed that, but.
Well, I have indeed.
But when you do, it's marvelous. So we need you.
Thank you, Andy. Yeah, I'll try and do more. And in terms of learning curve for people that are perhaps interested in keeping an eye on crypto, I suppose, with a view to investing, it's important to understand the operational risks and steer very clear of them with anything that you buy. Because I think the most common mistake is to buy a token and then find that it's associated with something that's just blown up, which happens all the time. For example, let's take Lido. It's a successful, what we call liquid staking company. And it's even now going to have its own blockchain. But until recently, it just offered staking on Ethereum, Polygon, and Solana, and a couple of other what we call proof of stake.
Yeah.
You see, I said you have to be rich to do the block building. You need 32S just to have one stake, and then the probability that you're chosen would just be 1 out of like 100 people who've got their 32S.
Yeah.
And you may not have 32S, but you could use Lido to combine your S with other people's, and then you just get a share of the profits. It's like a cooperative.
Yeah.
Thinking. And you'd think that would be enough, but no. They give you something called STS or ST Polygon. That's the dot, actually. ST dot. Sorry, that's polka dot. Anyway, so they give you the ST coin, which you can then use as collateral to get a loan to get more S. And it's a magic money tree going around. It's got to blow up. And it's not just with the staking. It's also with we didn't talk at all about DeFi.
Oh, yeah. That's a whole nother podcast. Yeah.
Yeah, different thing. But on the DeFi side, the way trading is done is through something called liquidity pools. And there's an identical magic money tree going on with putting liquidity into pools. You get a liquidity token, which you can use as collateral to get more of the native tokens and put those into the pools. And
wow.
And so the companies that are bound up with these things, which are, I think I mentioned in the podcast, I haven't had a time to blog, but apart from Binance, watch that space. The things to watch this year are those operational risks in DeFi. So if you're going to buy a coin, make sure that you steer clear of all this yield farming, staking, this type of thing, because there's a lot of double counting going on.
There's a gold rush mentality as I've been to different conferences and listened to different speeches. It feels very much like 1993 and 92 to me in Silicon Valley. People talk about what they're going to build more than what they built. They've talked about the money they've raised more than the money they've earned. They talk about if I hear the word serial entrepreneur one more time, I think I'm going to blow my stack. Of who they have, who's on our team, how much have we raised and what we're going to do rather than the money we've earned and what we have done. It feels like that to me. And I tell people, I says, look, I don't know what token is going to rise to the top or if it'll be a new world with multiple tokens, much like in the old 1800s in the United States, you had, no central banks and you had wildcat banks everywhere and people getting their own currency all the time. It happened all the time in the United States. People would have some specie and, hopefully their paper was backed by that. But I do tell people, don't be afraid of investing. I still enjoy stocks because they produce value to people. When I buy ExxonMobil, I'm producing energy. When I buy Kraft Heinz, I'm producing food. When I buy whatever it is I want to buy, I feel like I'm in production, and whether I'm going to get paid in dollars or pounds or euros or ETH or Bitcoin or whatever it might be, if I'm on the side of producing value, currency used to be seashells and feathers and coins, and currency has evolved all the time. But the ability to go to work and produce value to people, I think, is a consistent idea. So I hope people don't get enamored in the currency as if it's just a medium of exchange. Bitcoin certainly hasn't been a medium of exchange. It's been more of a commodity to store wealth or transfer large amounts of wealth, but it's certainly a brave new world. Any advice as we close, any advice for listeners on what they might look for in the future?
I don't have any hot investment tips. No.
Well, I thought I'd give it a shot because I know you're smarter than I am. So anytime we can get an idea, we should try for it. Carol Alexander, what a wonderful, gentle lady you are, and just so kind of you to take time out of your evening in the UK to visit us on our podcast. I think the listeners are going to love what you have to say and be excited to to follow what you do, and we hope you will give us more information, because your grasp of this topic is just wonderful and rare. So thank you so much. This has been the Cashflow Academy podcast. I'm your host, Andy Tanner. Difficult one to make simple, but this is where we do our very best to try to make investing simple. We'll see you next time.
You've been listening to the Cashflow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.